This is your Mortgage Rate Watch for Thursday, January the 13th, and I'm Keith Akada with the Mortgage Reel. So taking a look at the mortgage snapshot page here on the bonds, you're seeing that we are off of some of our best levels of day. And why is this? Just because at the 10 o'clock hour this morning, the 30-year bond auction received a C grading. Now, keep in mind we have been talking about the grading on the auctions are weighed heavily on the market. What's a little bit confused this morning is what's going on with Europe. Europe is all over the media right now. They're talking about interest rate hikes. There are now economists starting to say that they're pulling out of this. So there's a lot of debate going on over Europe, and that'll continue. What's also very interesting to pay attention to for the future is the Producers Price Index came out this morning, which rose sharply higher. Now, why is this something that we have to pay attention to? Well, looking into the crystal ball, with Producers Price Index coming sharply and higher, 1.1% higher over the expectations, what this really means is that the companies are going to have to determine where are they going to take the loss. Either they're going to keep the prices for products for the consumers at the same level, or they're going to pass on the higher cost of manufacturing, and instead of taking losses for the companies, they're going to pass that on to us, the consumers. So if they pass a price of production onto the consumers, well, of course, that means everything across the board, the cost of goods goes up. Cost of goods go up, they're striking number for inflation. So right here again, they're already in the talks about inflation and how that's going to impact the future. Well, if this is the case, and this is just January, and in the first month that we're into this, then it is showing that we are looking towards this summer, the cost of goods of everything going up. Now, with the higher cost of fuel, unfortunately, we mentioned yesterday on the Alaska pipeline and what that's doing. Well, the implications is, as we saw 4 years ago, when the cost of fuel rises too dramatically, what happens to everything to the consumer? The price of milk, everything at the grocery store, all costs of goods that we buy as consumers rises. Well, that's a sign of inflation. So keep in mind that inflation, that word alone, spooks the bond markets. It hasn't had the impact that was normally expected this morning, but it is something that we have to pay very close attention to for the future. So if you are looking again into this crystal ball of the future, what are you really looking at? Well, overall, you can say if inflation is returning because the cost of goods could potentially go up, plus the cost of fuel this summer being higher, and for us, the consumer, everything costing more, then inflation is here. If inflation is here, that pretty much stifles any rumors that interest rates are going back below some of the best levels we've already seen in the beginning of 2011. For more information, make sure to check back to our Facebook fan page. Leave any comments below that you found interesting about today's article, even just to say that you appreciated the post. And we'll also today, we're putting the final touches on the Fannie Mae and Freddie Mac impact on the changes they recently had on all their rules. So we'll have that up today. Make sure to follow us on our Facebook fan page, and we'll be back tomorrow. Talk to you soon.